let's talk about something that millions of people consider every year: taking a loan from your 401k. I mean, on the surface, it seems like a no-brainer, right? It's convenient, it's fast, it's your own money. But as we're about to dig into, the real costs are often buried deep in the fine print and, the kind of complicated math of your own financial future. And trust me, those costs can be way, way higher than you think.
So here's the game plan for today. We're going to start with why these loans look so good in the first place, then cover the obvious upsides. After that, we'll start peeling back the layers on the hidden consequences. We're going to spend some serious time on the superheated double taxation debate, look at some smarter alternatives, and wrap it all up with the final calculation you need to make for yourself.
All right, let's dive right in. The story of a 401k loan almost always starts the same way. You need cash, and you need it now. And when that pressure hits, that big, beautiful, growing number in your retirement account starts to look less like a future plan and more like a present-day solution, just sitting there, waiting for you.
And this is that moment, isn't it? The air conditioner dies in the middle of summer, a medical bill shows up that you weren't expecting, or maybe you're just sick and tired of staring at a credit card statement with a crazy 20-something% interest rate. Whatever it is, you need a big chunk of money, and you need it fast. That temptation to just tap your 401k is incredibly real.
So what exactly is this thing? Well, a 401k loan is basically a feature your company might offer that lets you borrow from your own savings. The IRS has some ground rules, of course. Generally, you can take out up to half of your vested balance. That's the portion of the money that's 100% yours to keep, but it's capped at a maximum of $50,000.
Let's make this super clear with an example. So meet Sarah. She's got $80,000 in her 401k that's fully vested. It's all hers. According to the rules, she can borrow up to half of that, so $40,000. She decides she needs $20,000 for a kitchen remodel. She takes the loan, and for the next 5 years, the payments, plus interest, are just automatically taken right out of her paycheck. Seems pretty slick and simple, right?
And Sarah's situation is the perfect way to see why these loans are so darn popular. There are some really obvious, right-in-your-face advantages that make it feel less like you're taking on debt and more like you found some kind of financial life hack.
And this right here, this is the appeal. First off, no credit check. It doesn't matter what your FICO score is. The interest rate, it's usually just a couple points over the prime rate, which is almost always going to be way, way lower than a credit card. And here is the absolute best part, the killer feature: the interest you pay doesn't go to some bank. It goes right back into your own 401k account. I mean, it literally feels like you're just paying yourself back.
Okay, but this is where the story takes a turn. That amazing convenience comes with some very real and often totally hidden consequences. These are the risks that can quietly and seriously mess up your retirement goals if you're not paying close attention.
So the first, and honestly the biggest hidden cost, is lost growth. That money you borrowed, Sarah's $20,000, is pulled completely out of the stock market. It's just sitting on the sidelines, it's not invested, it's not earning dividends, it's not compounding, it's doing nothing. So if the market goes on a tear while your loan is out, you miss out on all of those gains. That smaller bar on the right, that's a gap in your savings that you can literally never get back. The lost time is gone forever.
And that brings us to the next risk. And folks, this one is a monster. It's the job change risk. Your loan is tied directly to your employer. So if you quit, get laid off, or even get fired, your plan can demand you repay the entire outstanding balance in a really short window. Sometimes you only get 60 days. If you can't come up with thousands of dollars that quickly, the loan defaults, it's treated as a withdrawal, and bam, you get hit with income taxes and a potential 10% early withdrawal penalty. A simple job change can become an absolute tax nightmare, just like that.
All right, strap in, because now we're getting into the most controversial, most confusing, and most argued about part of this whole topic: the great debate around double taxation. This is something financial planners and accountants argue about, so we're going to break it down really, really carefully. This quote really gets right to the point. This is the core of the argument against taking out a 401k loan. The big scary claim is that the interest part of your repayment gets hit with taxes not just once, but twice. So how could that possibly work? Let's take a look.
Okay, so the logic is a little different depending on what kind of 401k you have. Let's start with a traditional 401k. You make your loan repayments from your paycheck, right? Well, that money's already been taxed. So you're using after-tax dollars to pay back the loan. That money, specifically the interest part, goes into your pre-tax retirement account. Then, years down the road when you retire, you withdraw that money and it gets taxed again as income. See? Tax number 1 on your paycheck, tax number 2 on the withdrawal. For a Roth 401k, it's a bit different. It's a subtler sting. You're still paying with after-tax dollars, but that interest money you put back in doesn't get the awesome tax-free growth that all your normal contributions do. You're losing a tax benefit.
Let's actually walk through the numbers so you can see it in action. So let's say you pay $2,000 in interest on your loan. Now, to have $2,000 cash in your hand for that payment, if you're in a 25% tax bracket, you first had to earn $2,667. The first tax hit is that $667 that went to the government. Then that $2,000 goes back into your traditional 401k. Fast forward a few decades, when you pull that money out in retirement, that same $2,000 gets taxed again. At the same 25% rate, that's another $500 in taxes. So when you add it all up, you've paid over $1,000 in taxes on just $2,000 of interest.
Ouch.
But, and this is a big but, there's a really strong counterargument. Not everyone buys this double taxation thing. As this commenter, Dave, points out, if you look at it differently, the situation changes. The argument is that you're just paying normal taxes on 2 different pots of money at 2 different times. First, you're taxed on the salary you earn today to repay the loan. Second, you're taxed on the retirement money you take out decades from now. From this point of view, it's not the same dollar being taxed twice. It's just the normal taxation of 2 completely separate financial events. Okay, so we've got lost growth, a massive job change risk, and a super confusing tax debate. Given all that, it is absolutely critical that you look at every single other option before you even think about touching your retirement money. So what else is on the table? So financial experts will pretty much always point to these 3 things first. The best, number 1 gold standard option is your emergency fund. That's what it's there for. If that's not an option, a personal loan from a bank or a credit union can be a good choice, but you will need a decent credit score. And finally, there's the toughest option, but often the most powerful one, taking a hard, honest look at your budget to see where you can cut back and free up cash. And this little chart just makes the trade-offs crystal clear. The 401k loan definitely wins on convenience. No credit check, you pay the interest to yourself, it's easy. But a personal loan is completely separate from your retirement, and that's huge. Yeah, the interest goes to a bank, but there's no tax confusion, and most importantly, there is 0 direct risk to your nest egg. It keeps the debt from threatening your long-term future.
Okay, we've been through the good, the bad, and the very, very confusing. So it's time to bring it all home and figure out how you make the final call for your own situation. I love this quote from a Reddit user because it just perfectly boils down the one scenario where the math might actually be in favor of using your 401k. If your company offers a match, that's a 100% return on your money instantly. It's free money. Not even a nasty 20% credit card can beat a 100% return. So the advice is almost universal. Always, always contribute enough to get your full employer match. After you've done that, then attacking that high interest debt is the priority, and a 401k loan could be a tool for that, but only after you've locked in that free money.
So here is the bottom line. A 401k loan isn't inherently good or bad. Think of it like a power tool. It's not a simple hammer. It's a complex instrument with costs that aren't obvious. The true cost depends on what the stock market does, how stable your job is, and your personal tax situation. It's a tool that demands a ton of respect and a very clear-eyed look at all the risks involved.
And at the end of the day, that's really what this all boils down to. This is the one question you have to answer for yourself. You are making a direct trade. You're solving a problem for yourself today by potentially creating a problem for the person you'll be in 10, 20, or 30 years. So is that immediate relief worth the potential price tag for your future self? The right answer depends entirely on your own situation and what you value most.